All right, why don't we go ahead and get started? So if anyone would like to follow us on Instagram, you of course can do that. We're getting close to our 300-person goal that was imposed upon us. But anyway, yeah, feel free to do that. But let's get started. All right, so today we are going to talk about this time is different, I guess is the theme. So we're going to talk about what are the reasons to actually justify valuation levels right now? And does that make sense? So I know I always come on here and talk about why I think the market's overvalued, but we're going to take a different approach and just see, just see the other side of it. But first, we need to go through some of the housekeeping items. So anything you hear today is general advice. Can't offer you personal advice. So yeah, go speak to a financial advisor if you would like personal advice. The other thing is that if you're in New Zealand and you want a copy of our FAP, you can go to our website at morningstar.com.au and get that. And I'm Mark LaMonica, and I look after the individual investor team here in Australia. And yeah, I'm going to take you through today's webinar. Okay, let me reshare my screen. And obviously, questions would be appreciated. I think today will be shorter, depending upon questions, of course. So get any questions in. But yeah, this time is different. So this time is different is a phrase that we hear a lot in investing. And basically, it is used kind of tongue in cheek that people justify high valuations, bubbles, when we're still in a bubble. And then, of course, we find out later that, in fact, this time is not different. And that's when the bubble bursts, or that is after the bubble bursts. So threw together a couple newspapers here, looking at the 20s and the 2000s and 2008. So all big bubbles, obviously. And I do want to thank Shawnee for putting together this deck. I had all sorts of things to do today, so she helped out with that. That's why this one will be different. But we're going to take the other side of the coin. So I've sat here, as I said, for a long time, talking about how I think the market's overvalued and talking about people who think the market's overvalued. But we're going to take a step back and look at all the reasons why maybe the market is fairly priced and will keep going up. All right. So let's go through some of these different justifications. So it is, at the end of the day, a kind of fact that compared to historic ranges, the market is overvalued. So that is a fact. We're going to look at some of the reasons why it actually might be. So one thing that we hear a lot is low interest rates justify high valuations. So we have on this chart here, which I like, we have the CAPE ratio. So the CAPE ratio is the cyclically adjusted PE ratio. So what we're looking at is price to earnings, so a relative valuation technique. But price to earnings, of course, can bounce around a lot because both the P and the E move. So price and earnings move, and that can cause it to bounce around a lot. We saw this a lot last year where the E went down a lot, so earnings went down a lot with COVID restrictions. But cyclically adjusted basically means that we're going back and we're looking over a 10-year period. We're kind of averaging out those highs and lows so that small changes or changes during like a particular year are not going to throw off this ratio. So we can see here that where are we? Well, from the CAPE ratio perspective, market's pretty expensive, right? So not as expensive as it was in 2000, but we can see, up there with 1929 and a lot more expensive than it has been historically. But a justification for where we are with the market right now is interest rate levels. So you can see also on here, we have long-term interest rates. So you can see down here, this is the lowest they've ever been. Now, interest rates influence all sorts of asset prices. So they certainly influence bond prices kind of directly, but they influence housing prices and they influence stock prices. We're going to talk about stock prices today. So why do they influence it? They influence it because when we are valuing stocks or anything with a cash flow, so whether that's a project at work you're trying to sell to somebody, whether it is a share where you're buying a business that has future cash flows, anytime that we are valuing something with cash flows, we are going to discount those cash flows back to the present day. And the input that goes into that, one of the large inputs, of course, is the level of interest rates. So what does that mean? That means that as interest rates come down, valuations will go up. So equity values should go up. Bond prices definitely go up. So that's a direct relationship. Housing prices should go up with lower interest rates. So the argument, of course, is that because interest rates are so low, that this, in this case, whatever valuation measure we want to look at, this CAPE ratio is not, in fact, expensive and is justified by the lowest interest rates we've ever seen. So that is certainly one argument of why the market is not overvalued. And I'm not going to go through and give all the counter arguments because that would defeat the purpose, because that's what I normally do. All right. And the other important thing for today, before I keep going in this, the other important thing is that as investors, we always need to challenge ourselves on, basically challenge our thinking. What if what we think is not true? So this is a good exercise. If you're like me and you tend to think that the market is overvalued, this is a good exercise to challenge yourself or challenge that thinking. And then, of course, if you think the market is fairly valued, then you should agree with all this stuff. And yeah, you can listen to everything else I say, which is me basically talking about it being overvalued. Another thing we can look at is that we have had central banks, so we're talking about the Fed here, but all central banks have been a lot more activist than they ever had in the past. So they have been willing to go to extraordinary measures, they would say, to support the economy, but also it has an influence on asset prices. And basically what these extraordinary measures that they never did before the GFC is the degree to which they have blown up their balance sheet with more and more assets. So we've got a couple examples here of just what recently happened. Now, if we go back in time, we can see huge step up during the GFC, steady growth since then, huge step up right here with COVID. And you can see just between December 2019, where we were all ignorantly unaware of COVID and what it was going to do, and where we are right now, you can see huge expansions of the Fed, European Central Bank, Bank of Japan, and of course, right here in Australia, the RBA. Now, what have they been doing with this balance sheet expansion, and what does this mean? And I think all this stuff blurs together at some point for me, but I think we talked about this. Good question, Ronald. I'll get to that in 1 second. We talked about this maybe a week ago or something like that, but let's talk a little bit about what central banks are actually doing here. So central banks essentially have a blank checkbook. Why? Because they actually create money. So we always think about who creates money, like, oh, you print money and coins, everything else. But the money supply obviously is much bigger than physical currency. And who really creates that money supply? Well, a lot of it is the Fed in the US or a central bank, whatever country you are. So central banks have expanded their assets a lot because what they're doing is they're going out there and they're buying bonds. So when we talk about their balance sheet, just like the balance sheet of any other company, a bond is an asset. If you were a bank and you went out there and bought a bond, that would sit on your balance sheet and that would be an asset. Same thing with the central bank. The difference is they have an unlimited checkbook. So they've been going out there and buying bonds. Why are they buying bonds? So they're buying bonds to push more money into the market and keep interest rates low. All right. So at the end of the day, that is their goal. What they used to do is they would just buy short-term bonds. So that's called open market activities. And that's the interest rate they would worry about. So in Australia, the RBA is looking at that overnight rate. So those are very short-term government securities they would buy. A lot of central banks moved out buying longer term securities. So that's called quantitative easing. So you'll hear that, QE, quantitative easing. So they're buying longer term government securities. They've also bought, historically, the Fed during the financial crisis bought mortgage debt, so mortgage-backed securities. And then they bought some corporate bonds during this COVID crisis. But anyway, they're buying all of these bonds. They're taking them off the market and they're holding them on their balance sheet. Now, of course, they're a bank, just like any other financial institution. So as that interest is paid and as those bonds mature, or they could sell them, they will come off the balance sheet, but not if they're continually replacing them, right? So when you hear these terms like taper, so we hear tapering all the time. What is tapering? Tapering just means that would be a slowing of asset purchases, not selling, just slowing asset purchases. So The story behind this is that because of unemployment, because of all sorts of other different reasons, the Fed and other central banks will continue to intervene in the market. That will prop up asset prices. And as an investor, that's of course a good thing, right? It means that there's almost this Fed floor on security prices. Because if something goes wrong, like there's a pandemic, like the GFC happens, like unemployment goes up, because something goes wrong, or when something goes wrong, central banks will step in. They will expand their balance sheets further, which ultimately is good for asset values. And like the simple way of thinking about this from an investor standpoint is of course just the fact that there is a substitution effect that as interest rates go down and down and down and down, maybe you've done this yourself, that all of a sudden cash doesn't look good, bonds don't look good. So what do people do? They buy shares. So yeah, and we've got a good question from Ronald. So he's saying, where is the Chinese central bank on this thing? So we certainly did not look at the People's Bank of China. So the People's Bank of China has not expanded their balance sheet as much. So they expanded their balance sheet 6%, basically from the start of COVID on, so that same time period. And basically what they did, and Peter Warnes has been talking about this, what they basically did is they supported the economy in a different way, or China supported the economy in a different way. They just spent a ton of money on infrastructure. And, Peter Warnes talks about this all the time, and I don't remember the exact fact he used, but something like China pours the same amount of concrete in 2 years as the US did during the 20th century. So basically what they did to support the economy is instead of, inflating their balance sheet and propping up asset prices and making sure that there was still capital available for companies to go out there, they just built a bunch of stuff. And we've seen the benefits of that here in Australia, obviously, because a lot of this building, as Peter talks about all the time, has, of course, used ingredients from Australia, like iron ore. So yeah, that's what China has done. So yeah, they're nowhere as close, obviously. 6% is not that much in terms of balance sheet expansion. All right, so another theory in why share prices have continued to go up and will continue to go up is antitrust. So let's talk about antitrust. So antitrust basically means that when a company gets to a certain degree of, however we want to call it, basically market share at the end of the day, and is hurting consumers, governments will step in and either break that company apart or they will disallow it from making acquisitions. So basically, it is in the best interest. And where this came out of course, is sort of the turn of the century. Teddy Roosevelt, the trust buster. And the idea was that as companies got this monopolistic power, they of course hurt consumers because they could charge whatever they want. And that's really what was happening back there. So all these antitrust regulations were written across the world. And yeah, countries would prevent companies from taking too much market share. Now, one of the tests around antitrust is sort of the two stages. One, that you have to, have this sort of what is deemed monopolistic control of a certain market or industry. And it had to lead to bad consumer outcomes. And that second part is really, really important. And over time, that's how it's sort of interpreted. So particularly with the Justice Department in the US. Now, what has happened recently is all of the companies that have gotten huge amounts of market share have been deemed to not be hurting consumers. And one of the reasons is a lot of them either have free products for consumers or have been driving down prices. So we're going to look at the FANG stocks, or whatever the stupid, I don't even know how to say the stupid analogy with the G in there. But we're going to look at Apple, Microsoft, Amazon, Facebook, Alphabet. So let's go through these companies very quickly. So, Apple at the end of the day has a huge market cap, which we'll get into in a second, but not as much market share as the other ones. And at the end of the day, iPhones are sort of a premium product. And if we look globally at the number of smartphones sold, yeah, not a huge amount. We look at the other ones. So Microsoft, Amazon, Facebook, Alphabet have all grown significantly. Microsoft, of course, famously went through some antitrust stuff back in the early 2000s. But if we look at Amazon, so Amazon has the argument it has not had bad consumer outcomes, right? Because they have continually driven prices down, which is, of course, good for consumers, not so good for any business competing with them. And they have slowly gobbled up more and more market share. Obviously, this is mostly sort of US, not here. Facebook, their products are free. So, that has been deemed not a bad outcome for consumers because they're not getting charged to upload your weird pictures onto Facebook. Google, of course, if we look at sort of where a lot of, if we look at sort of market share, yeah, like Google Maps and of course search, like all free. Obviously, they're selling advertising, making a lot of money. All these companies are making a lot of money, but they have been deemed to not be bad for consumers. So that's beginning to change. But what has happened is these companies have taken up huge amounts of market share. They have then become huge companies in terms of market capitalization. So how big are the companies? How much are they worth? And as they've gotten bigger and kept getting bigger, it has, of course, dragged market indices up because we live in a market cap weighted world where the bigger the company makes up more of the index than smaller companies. So as the big companies keep getting bigger and keep doing better, they will be worth more in the market and they will keep dragging up this index, right? So this is where we've seen, and if we go back and we look at how a market cap weighted index has performed versus an equal weighted index where every company is an equal weight in there, the market cap has done better because these big companies have done better. And what's allowed them to do better is the fact that they can continue to grow and have not worried at all about antitrust. So, and this is good for us as investors at the end of the day. It's good for us if we are passive investors because we are most likely owning a market cap weighted index. And, at the end of the day, and Shani and I just did a podcast on this, at the end of the day, and we're looking at the ASX 200. And the ASX 200, of course, is, kind of dominated by, so there's something like 44% of the ASX 200 is in the top 10 companies. And, with BHP, Lusting in London. That sounds like a movie that I should not watch on my work computer. But with BHP ending their listing in London, coming back to Australia, they could be close to 12% of the index. So we're seeing the same thing. So if I just own an index, yeah, I'm getting dragged up. So it's a very good thing for me. I don't really care what happens to the 199th smallest company in the ASX 200 because it has next to no impact on my passive investment in that index. So it's one of these things where, you see people come out and say, yeah, I love this ETF where I can go in there and get exposure to 200 companies, but are you really getting exposure to 200 companies? Like the exposure to a lot of them is so small, it doesn't matter. So big companies doing well does good things for indexes, which of course does good things for investors that are passively investing. So as I said, while there are some discussions about kind of restraining tech companies' power, like we've seen a lot in Europe, starting to see it in the US, this could be a change, but for now, these companies keep growing. They'll keep dragging everything up. You look at every active manager, they all own them as well. So yeah, this has been good for the average investor. All right. Another reason that valuations are justified is we have had a big shift in the economy. So on the left, we've got sort of old school economy, right? Where much more industrial. So kind of you go back and look at any time, like go back to the 50s or go back before, and obviously times after that as well. Go back and look at the composition of indexes. So what is it? Most of them were industrials, right? Because those are the companies. You manufactured something and then you took that and you sold it. And how do you manufacture it? You need factories. So basically we've moved from a fixed asset based economy to something that much more is asset light. So what we mean by this is that if I'm a company and I need to build a factory, so I don't know what you make in a factory. I know everything gets made in a factory, but I'm making a factory that's making water glasses, right? And I want to expand. What do I need to do? Well, I need to probably build another factory or expand my factory. So it takes a lot of capital to expand. So you do not have the ability to scale your company in the same way. As investors, what that means for us is the companies that we own have to go out there and they have to borrow a bunch of money, or they have to issue more equity, which we don't like, right? Because we get diluted, and they need this so they can expand. And they build another factory, and then soon, a couple of years later, they're making more water glasses and they can get more market share. And if they want to expand to a different state or a different country, they need to build more factories. So you've got this notion where scaling your business was very expensive. And as investors, of course, that capital that was spent is ours. It's our company either borrowing it or it is issuing more shares, which dilutes us as investors. So what have we moved to? We've got, like, Shani found a picture of like the tech bros hanging out with their whiteboard and their Macs. Yeah, this is what's turned into. Now you have these companies like the ones I was talking about before, where, the story I always tell about Instagram was sold for $1 billion and had like 11 employees, right? Like that could never happen in the industrial era. So what does that mean? We have these asset-light companies. These asset-light companies are better for us as investors. They're better businesses. And they're better businesses because they're scalable. Because you don't have to build a new factory if you want to get another billion people onto Facebook, right? Yes, there are some costs associated with it, but at the end of the day, you don't need that many more people. You don't need that many more investments. You can just sort of scale these internet businesses almost forever, right? And that's very good for us as investors, because what it means is that as these companies grow, their margin comes down. Sorry, their margin goes up. As these companies grow, their margin goes up, meaning they're making more money. So if I'm in the water glass company and if I'm selling 1 million of these a year and I can make that in one factory, if I want to sell 2 million, I have to build another factory, right? So my marginal cost isn't coming down much, provided that factory is the same as the one I have now. If I'm Facebook and I keep scaling and scaling and scaling, and I'm making money off of every new user that I get on there, most of that is just profit. So as investors, that's very good for us, because then what do the companies do with that money? They don't have to invest it to continue to grow the business in the same way they used to. They give it to us. So they give it to us in share buybacks. They give it to us in dividends. So this justifies, of course, higher valuations, because most valuation measures, we're looking at like that CAPE P ratio, for example, or any P ratio. We're sitting there talking about earnings. Well, same time, if we're generating a lot more cash and we can grow those earnings a lot faster, that's good for us, right? It's more growth. It is better for investors, and that, of course, justifies the valuation levels. All right, we got some questions. I will get to those questions in a second. We're gonna keep going. Oh, I'm very far behind. I don't know why. I'm not even looking at my notes. All right. The other thing that we hear a lot is this bounce back from COVID, right? So valuations are justified by the fact that we're all anticipating this bounce back from COVID. So you hear all sorts of things about this is going to be like a repeat of the 1920s. I don't know why people keep saying that, because we all know what happened at the end of the 1920s with a giant stock market crash and then, Great Depression followed by World War II. So I don't really know why everyone keeps talking about that like it's a great thing. But there is, of course, this notion, and I think it's happening, that as soon as we get let out of our houses again, what are we going to do? We're going to start going out there and spending money. So it's I think a real thing. And that this justifies the multiples that the market is trading at, because there's going to be all this growth. I will say that I think Peter Warrens wrote about this pretty interestingly when he was looking at sort of half-yearly results recently. And he said, just be careful where that money goes, right? So everybody's been sitting there spending all their money at Bunnings, trying to like redo their house and buying new televisions and Harvey Norman and all this stuff. But all of a sudden, like, maybe a lot of that is because they can't go out to restaurants and they can't travel, and, that spending will shift. But, Peter knows far more than I do. But anyway, another justification for where we are, that we're going to see this bounce back and we're going to enter a period of a lot of growth. And we're seeing some of this with inflation, right? It's been some of the problems that have happened, that like the sort of system to produce goods and services is still sort of gummed up. And all of a sudden there's this explosion of demand and it's not being met by supply. And all of a sudden off goes inflation. We did it. Anyway, thank you guys very much for joining. And for some of you that are really sick of being locked in your house, I will see you a little bit later.
Any advice in this video is general advice or regulated financial advice under New Zealand law, prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.